you wrote in a recent update, the Fed has a dual mandate to maintain price stability and reduce unemployment. These two goals are not complementary in the short run, as economists wrongly once assumed. There are times when the Fed has to choose one goal at the expense of the other. That seems to be on the cusp of what's happening now because of these recessions. Which one would they choose?
I think that's the right way to frame it. And they're going to fight inflation, even if unemployment goes up a little bit. Now, their advantage at the moment is that inflation is, if not quite out of control, dangerously close to being out of control. It's 8.6% in the United States, highest in over 40 years. And it wasn't a 1 month anomaly. It's 2021 was 7% for the full year. You go to the months in 2022, it's whether it's 8.4, 8.2, 8.6, it's been running at a very hot level and in danger of getting worse. So they've got to fight the inflation. That's clear. Fortunately for the Fed, unemployment is, as we measure it, and there are all kinds of problems with the measurements, but as we measure it, I think it's 3.6%. If I'm off the 10th, 3.5, 3.6, which is extremely low, but both in the absolute sense and historically. So the Fed they're going to have to make the trade-off. They're going to have to fight inflation and watch unemployment go up. That is going to happen. But they're fortunate in the sense that unemployment is so low, put differently, the jobs market is so strong that they can afford to see it go up a little bit without an uproar, whereas there's absolutely an uproar over inflation. So there are times when that is a more difficult choice, but right now it's an easy choice because inflation is a danger and unemployment is not. Now, what is much more difficult about that trade-off is that what I just described is where we are right now, and it's very easy to forecast Fed policy. They're going to raise rates again at the end of July, again in September, again in November, whether it's 75 basis points or 50 basis points. I always say it's easy to forecast the Fed because they actually tell you what they're doing. All you have to do is listen and believe them. But so right now, whether it's 50 or 75, hard to say. Probably 75, but they'll give us more leaks and so forth before the end of July, so we'll have a better idea. But let's just say 75 basis points. But at that point, you're up to 2.5%, or 2.5%. In 4 months. This only started in March, and on March 1st, rates were zero, and then they went 25, 50, 75. So that gets it up to 1.5, and if it's 75 more, then you're 2.25 in a matter of 4 months. That's very, very rapid. That's the fastest rate of increase since the Volcker days in the early 1980s, and then again more in September and November. So that's to fight inflation. Now, the problem is the inflation is not coming from the demand side, it's coming from the supply side. And they're both inflation in terms of measuring price increases, but they're completely different dynamics, completely different sources. When energy prices are going up, food prices are going up because there's no fertilizer, because nitrogen fertilizer comes from Russia and they can't get any, or just the cost of diesel fuel in your tractor makes it more expensive to plow the fields, or labor costs are going up, transportation costs. You get the crop, you got to get it to a processing facility. Well, that takes a truck, and a truck takes diesel, and diesel is $6 a gallon, et cetera. So there are all these dynamics coming from the supply side. The Fed can't do anything about any of those things. The Fed does not pump for oil. The Fed does not plant crops. The Fed does not drive trucks. And so what can they do? Well, they can destroy demand. They can do that pretty effectively. Raising rates, raising mortgage rates, increasing monthly payments for homeowners, increasing interest rates on credit cards. It plays out in a lot of different respects. And increasing unemployment, which we just talked about. So the Fed can destroy demand, which can reduce prices, but it does it at the cost of a recession. And as recently as a few months ago, maybe even more recently, the number one question I was getting was, hey, Jim, do you think there's going to be a recession? And I said, yes. And I thought, well, watch out in the fourth quarter, watch out in early 2023. Well, we don't have to answer that question anymore because we're in a recession. I mean, it's here. A recession is conventionally defined as 2 consecutive quarters of declining GDP, First quarter is in the books, down 1.6%. Second quarter is closed. We will not have a government number on that until the end of July. Of course, second quarter is over June 30th, but we won't have the official number until the end of July. But we have a pretty good estimate from the Federal Reserve Bank of Atlanta, and their latest estimate, including some good export numbers that came out very recently, shows down 1.9%. Well, sorry, down 1.6, down 1.9. There's your 2 consecutive quarters of declining GDP. Now, it's not the end of the world. It's not a financial crisis, but that is a recession. We're probably in one right now, almost certainly in a recession. And so then the question isn't, will there be a recession because we're in one? The question is, how bad will it get? And the answer is it could get much, much worse. So you have this phenomenon. We just said, okay, the Fed, between employment and inflation, they're going to raise rates to fight inflation. And yet here they are raising rates in the teeth of a recession. How does that work? Well, the answer is it makes the recession worse. So we may see some shocks at the end of the year. In fact, I expect we will. People have laid out this path of interest rate hikes going into 2023 and late 2023, early 2024, getting up to 4.5%. Don't be surprised if the Fed actually cuts rates by the first quarter of 2023. That's what markets are saying. When you look at inversion in the Eurodollar futures curve, that's a little bit technical, but it's there, and it has a very good track record of predicting recessions. And right now, it's saying there will be a recession.